I'm Zane Van Dusen, and this is what you need to know about credit risk surveillance. After all we've seen in 2022 and 2023, firms are really reassessing how they think about credit risk. The last time they really did a big revamp of their credit risk processes was back in 2007, 2008, in the aftermath of the financial crisis. And unfortunately, or fortunately, there hasn't been a big stress to those frameworks since then. And so they're learning now that there's various gaps in that framework, whether it be due to slow-moving data or low coverage or manual analysis, that they now have to incorporate and now have to deal with, now that we're seeing a much faster moving market with really high interest rates. If you think about post-2020, we're seeing a lot more events popping up that are causing volatility in the market, that are spooking investors around the credit quality or the credit worthiness of different sectors or companies within those sectors. There's a big focus these days as we talk to clients around looking for early warning indicators. And early warning indicators are all about trying to figure out what is potentially priced into different areas of the market that are not priced into other areas of the market that other people might not be seeing, so that at least you can be on top of the curve, if not ahead of the curve, to identify the next name that may have an issue in the near future. I'm a big believer in that a lot of the information that you need about a company is generally in the market. And there's a lot of wisdom in the market. It's just figuring out how do you distill it properly. In many cases, these are things that are being traded by a small group of people who have really good information because they're researching the exact right things to understand what's driving the risks related with those companies. If we're able to look at things like bond pricing and the spreads associated with those bonds, that's going to help you understand if there's something going on that traders are already pricing in, which is really valuable if you're sitting in a risk management function, because in many cases, you're not looking at those names day to day. You have a much larger view across your firm, and therefore you need to have a better intel and better color around what's going on in the market. So if you look at things like the fixed income market and the equity market and layer it on top of traditional fundamentals analysis, that's where you can really get some interesting insights that can tell you ahead of a downgrade or default if there's a risk afoot. Historically, a lot of credit risk was done qualitatively based on people's understanding of companies. However, with the advances of technology and the data available, and just the fact that people have to look at so many more companies now, quantitative analysis is really coming to the forefront and becoming the backbone or the foundation of that analysis. So I think more and more credit risk analysis, especially when done correctly, will heavily rely on quantitative analysis with qualitative judgments done on top of that to make that final decision. I don't think we're anywhere near a situation where machine learning algorithms are going to make a decision on the creditworthiness of a name and investments will happen automatically. I think a lot of those classifications and initial judgments of a company will happen automatically through data science and through machine learning, with a qualitative lens being applied by credit risk officers who understand the market a bit more and can actually discuss with their colleagues and figure out what makes sense for a firm's investment strategy. I think credit risk is going to evolve in a way that's going to embrace technology a lot more than it has in previous years. A lot of the work that people do today is very manually based, but more and more people are being tasked with looking at more and more companies, more and more sectors, and it's just not scalable to look at all of them in this manual way. Many people live in a vacuum of looking at a specific sector, and being able to look across sectors, across a portfolio is what's really important. And then on top of that, being able to use the latest advances in machine learning to identify early warning indicators faster than your competitors is going to be a key to this. Figuring out how do I weight fundamentals versus equity data versus alternative data versus fixed income data will be the key to figuring out who are going to be the winners and losers in the future and making investment strategies based on that information. I'm Zane Van Dusen, and this is what you need to know about credit risk surveillance.